Hi, I'm Dolph Janis of Clear Income Strategies Group. I want to personally welcome you to our next webinar series, The Lost Decade. A lot of you might be familiar with The Lost Decade. Some you might not be familiar with The Lost Decade, but The Lost Decade was from 2000 to 2010, basically. And basically, people are called it The Lost Decade, as we'll cover throughout this presentation. Um, a lost decade where the returns and everything like that were not mirror to what's happened in the history of the market. So hope you enjoy this. This is a plethora of numbers. It can get confusing at times. I'm going to try to keep it as simple as possible. Had a gentleman who gave me a lot of these numbers for you, works for a high-end computer company in numbers, and that these charts are all prepared by him, and we ran them through to verify them that they are correct. So enjoy the lost decade, enjoy the presentation. Now, if you've watched any of my webinars before or know who I am, you always wonder where it began and why did I start getting in this industry in 2004? Well, back in the day, I worked in the casino business as a casino dealer and as a pit boss, and got a lot of friends out there. And the old proverbial "don't gamble what you can't afford to lose," like I call the stock market, is the market casino, the Wall Street casino, as one would say. But I started learning, watching these people lose and lose, and they were regulars coming in, and asked them these questions, and they just didn't know. They just figured like this was the only way they could make money, and it started getting to me. And like I said, educating people on how to play the game of craps. That was the main game that I dealt, and showing people the odds of what the craps table are, and they just kept on losing. And every once in a while they'd win and get excited, but when I got out of the casino business, it was more like, I want to continue educating. I enjoyed it with my golf career and everything else, of showing people preparing for the future is a lot easier than trying to get it all right now. And that's one of the reasons of why I got into this industry, is that I don't like seeing people lose money. I don't like to see people taking chances unless they want to take the chance. That's what life's all about, is taking chances, but making sure you take the correct chances to go forward with yourself. Like I said, I'm an educator first and advisor second for the last 17 years. I've been fortunate enough to be featured in all these publications, 3 articles in Forbes. These are all available on our website if you want to see any of these articles as well. I also wrote a book a year and a half ago called Cross the Bridge in Retirement. If you'd like to have a copy of that, please reply to this presentation or give us a call or an email. We'd be more than happy to get you either a PDF or a regular copy of this book out. I'm actually just started my second book. Hopefully to have it finished and published by the end of this year, especially after what we've gone through in the last 12 months now through this pandemic and the change of the world. That's why the lost decade is upon us again. And is it going to happen again? I mean, we're at all-time highs in the market. We don't know where the money's coming from. We have these $2 trillion, 1.9 plus surplus stimulus money is going out. We don't know where the money's going. Who's it going to affect at the end of the day? Who's spending our money besides the government? And that's something we need to know, because this all goes back to the tech days of 2000, when we had that crash in 2000, 2001, 2002, the 9/11. Then we had the whole thing there. And then we had the real estate bubble in 2008 and 2009. And then we went through a big jump and things started to go through. And then we had the Trump bump over the last 4 years. Now we have a new administration. So are we leaning ourselves into the lost decade? Remember, one of the quotes of one of my good clients, who he was one of the ones who helped out with this presentation, it's not always what you hear, but what is best for you that counts. I mean, that's a wonderful phrase. You hear a lot of things out there and people get excited about it. And like yesterday morning, I had an appointment with a client I talked to, and he retired 6 years ago. He had $480,000 in his portfolio. He went to a money manager. He was 60 years old. He was all excited, and him and his wife retired, and the money manager mishandled the funds, got too aggressive in the market. Well, then it dropped it all the way down to $43,000. And now the guy has to go back to work at 65 years old and figure out where his savings are, because he heard all this stuff of you could, you could, you could, you could. And just because you could do something doesn't mean you will do something. That's where guarantees are so important for a portion of your portfolio, and understanding of the lost decade coming out right now. If this happens again, I'm telling you, if this 10-year stretch, we go through this again, with the baby boomers and the Gen X's coming up, it could really impact someone's portfolio. And a lot of advisors out there, they're talking about the average return you have versus your actual return. And this is very important, because throughout this presentation, like I said, There is a plethora of numbers that will be shown to you over the next 20 minutes, and they're going to be confusing. And I'm going to try to make them as simple as possible, but there is confusing between an actual rate of return is and how much the investor actually makes compared to what the expected return is. Rather, the actual rate of return is a different way of calculating averages. Well, the average return are generally just the average returns averaged out over a period of time. So the question is what did you actually make, or what was your average return? Because depending on where that number falls can really hit you in the you know where for your financial portfolio. So if you look at the lost decades, have you ever heard of the lost decade? Well, there was one. This refers to the decade of 2000 2009, where the S&P lost money for the entire decade, a minus 9.12% collectively. This seems crazy given the performance of the S&P since then. The S&P has soared in the ensuing decade. But if you look back at history through this whole time, this has never happened again. On January 22nd of 2021, the S&P was at 3841. At the start of 2010, it was at 1115. That's a rise of 344 plus percent in that 10-year time frame. Over the second decade of the millennium, it's compounded rate of 11.9% again, percent return. Wonderful if done the correct way. Will this happen again? Oh, God, hope so, but it doesn't look like it. History should repeat itself in this aspect. But if we add the recovery of 2009 from the disaster of 2008, the return of the investment for the 11-year period is 437% or 15.6% a year. The S&P was 2133, 1,000 points higher than when Trump was elected in 2016. In Trump's 4 years alone, it rose another 1,708 points. Now let's revisit the lost decade in returns, and you can see from 2000 to 2009 that stretch there of those 10 years is look at the return. I mean, look at the S&P. If you invested, use $1 million, just great number of money, and we all wish we had it. Some of us do, some of us don't. But if you look at the S&P and you just stuck it out of the S&P, you didn't do anything like this. Mind you, this is with no fees attached. None of the stuff we're showing you is with no fees, because you can calculate the fees in there as well with you. I mean, like, did you buy your advisor a house? I always say during this 10-year frame, where you collectively lost a compounded performance of 1% a year for that 10 years, which is over a 9% loss for the whole decade. Now, if you tack on fees on top of that, the numbers speak for themselves. But don't think so much about what happened from 2010 to current. You got to remember what's happened in the past of this decade. And imagine if we go through a stretch like this again, how's that going to hurt your portfolio, especially if you're taking withdrawals out of your money? So signs of the lost decade revisited. There are a lot of changes with the new administration, if we haven't noticed, in the short time frame they've been in office. President Biden has issued over 50 plus executive orders. A lot of them have been most damaging to business in the private sector. Look at the Keystone, just for an example. Look at the price of gas, how it's gone up, altering how people's portfolios going. Many factors come into play. The America First policy is gone. The globalist policy is back. This puts the USA back in a new normal. Obama used to talk about it when jobs were outsourcing, smaller returns, etc. COVID-19 has swamped thousands of small businesses. Well, the large box stores and mega companies, they're doing fine for the most part, but they're still hurting a little bit, but not as bad as the small businesses. Stocks are personally overpriced, and all signs are pointing for a correction. It's not if, it's when. I mean, government regulations around COVID-19 is stifling the investment, entrepreneurship, and just disregarding leisure activity outside the home. You're captive on what you can and cannot do. Look at cruise ships, for example. Look at a lot of these vacation resorts, for example, hotels and so forth. I mean, the Las Vegas Golden Knights, one of my favorite hockey teams out there, was playing in San Jose a week and a half ago. And their game, they had a back-to-back game in San Jose. And that night, they got back to the hotel, and the next morning when they woke up, that hotel, which was a 4-star, 5-star hotel, went out of business and declared bankruptcy. And the Knights had to leave that hotel and go into another hotel that same day before going to play their game. It happens like a snap of a finger. Businesses just can't keep up sometimes right now with this pandemic going on, and it's very sad. And taxes are going to potentially soar under the Democrats. Historically, they've always been tax first mentality. And so if you watch the presentation we had a couple of weeks ago about President Biden's proposed tax plan of what it is, you'll see how taxes are going to be on the rise heavily going forward. If this seems plausible, then another lost decade could be upon us, commencing in 2021 or sometime soon. So let's see what it would feel like by examining the lost decade itself. Now, the Dow began the inauguration day in 2021 at 31,188. On January 29th, it dropped 3.84% just in those 9 days. Yes, it's come back. Again, this is the volatility we're talking about. This is the up and downs we're talking about, is where is it going to go from here? Now, for the next several slides, I'm going to pile a bunch of numbers on you, and I hope you don't get too lost in these. I know I'm going to try to make it as simple as possible, but note the fastest portfolio falls if nearly half is gone in 10 years. You cannot afford to lose money when you're in retirement. I mean, if you look at the plus and minus and the 4% rule, the lost decade, we fell short by over 13, almost a half percent. Actuals versus what if compares total wealth with withdrawals and net portfolios. So we're looking at this lost decade in front of us right now. You're just looking at the standard S&P in scenario one, doing what it's doing, and you're taking out 5% withdrawals out of your portfolio, and you started with $1 million. Look at the circle. Look at where the yield is at the end of where you're at of the lost decade. I mean, you're at 346,000 of withdrawals net after 544,000. Half your money is gone. I mean, yes, a lot of it came back recently, but we got to focus on if this happens again, you're looking at basically a 25.5% withdrawal difference between that and if you put it in a fixed product where you had just a 2% return, just 2%. Look at the difference in the values. You're $100 to $300,000 more money. But the actual versus the what if is what you focus on, is protection versus guarantee. You're at a 24% loss from the lost decade. This is just staying in the S&P, taking out 5%. Now, mind you, Morningstar is saying 4% or 3.5%. We like to go to the 5%. You got to maximize your money and maximize your growth. And the ironic thing is, a lot of people don't understand, you can switch those numbers up there, those 10 numbers, any which way you want. You can put the 3 negatives in the middle, the end, and vice versa, all your way around. In the lost decade, the number at the end of the day still comes out. So can you afford a 25% dip in your portfolio over 10 years and be taking out money? It's a question you have to think and prepare yourself for. Now, if you compare the lost decade in reverse to conservatives, the what ifs, as I just mentioned, you flip-flop the numbers, they come out the same way, if not even a little bit worse, but still, barring in that 2% return, scenario one versus scenario two, you're still looking at an 18.29% wealth difference, whereby if you put it in just a fixed bucket, even only earning 2%, I mean, you're getting a positive. I mean, if your annual income's at 4% there, you're looking at this. And had the lost decade come in reverse order, the actual performance is a little better on the withdrawals, but the net portfolio result is exactly the same. I mean, 18.29% is a lot better. I mean, it's better if you look at the 34.13 on your net portfolio, and that's just gaining 2%. Again, mind you, these have no fees attached to them. So the fees will eat up a lot of this other rates because you're in the investment world of that part. But you cannot bet the farm on the S&P in the lost decade situation. You just don't know what's going to happen. Now, if you review the order investments options in the lost decade, we're going to visit some different caps and some different other strategies in case outside of the S&P. If you look at like a small mid-cap portfolio, the portfolio grew 41.25%, and the compounded yearly growth of 3.54%. Heck of a lot better than the S&P. But the comments on the small cap equity is Edelman, Financial, Fidelity, others recommended visiting small cap positioning in 2021 in January. The globalist politics are back. Small cap flourishes in population, not globalism. COVID-19 has swapped many smaller business in the entire sectors, such as food service, travel, and techs like Parlor. Mega companies like Google, Amazon, Microsoft threaten to overtake everything. This sector, the last decade, did 3.5%, which is decent, but not significant if you're looking at a whole retirement portfolio. The Biden administration will do a much tougher situation for small caps to succeed going forward in the future. Let's look at high yield bonds during the last decade. Again, the portfolio grew 91.6%. Compounded yearly growth was 6.71%. comments on high yield bonds. They're fairly strong performance in the last decade, but there's that big but where we don't like to see that word but or however. Bond yields today are way lower than they were in 2000, 2009. All you have to do is look at them. They're not as attractive as they were. We have seen the 10-year bond dip into negative yields in recent times. An actual article on high yield bonding. Look, you can click this article and get this to you. And I'm seeing a bunch of questions coming in, Dolph, saying, wow, these are a lot of numbers. I appreciate you guys asking these questions. And I said, this is something I said, I have 35 minutes. I'd like to share this information with you. I appreciate your questions. I will get to each and every one of them. And we will show you these slides and we'll get them to you as well. So I appreciate that. These are actual numbers, folks. And it's an eye opener to some. I mean, seeing how that lost decade is depending on where you are. But I said I will get to those questions for you. But this high yield report with Fish USA is high yield defaults in sight. Default rates elevated through 2022. Posted finished at 5.5% in 2020. Amazing article that was written a few months ago on bond reports, because if you're open to supplement to a portfolio but riding bond exclusively for 10 years, it's risky. The swings we've seen in this game that the Fed plays are astronomical. So again, where do I go from here? What's my next step? So let's go. Whoops, sorry, here my mouse is frozen. Is a review and stuff in U.S. bonds. I mean, the portfolio in the last decade grew at 84.7%, an unbelievable compounded growth of 6.33%, but fairly strong performance in the last decade. But yield bonds are again way down. Return in 2020 for a yield bond, a U.S. bond, was 0.93%. Big difference from the 6.33. Mind you, again, this is all without fees. Fed intend to keep this interest rates very low. It's one of the things they've talked about. It's one of the things they're enhancing, as they're saying we want to keep the rates low. If you look at the last 3 years of bonds, in 18 it was 2.83, 19 1.86, and 20 was 0.93%. Again, not recommended. So let's look at international bonds. Let's travel across the seas and see how that works on the international bond portfolio. During the last decade, portfolio grew at 87.21%. Great compounded yearly growth of 6.47%, unbelievable. But they're very strong performance during the last decade. But again, Feds intend to keep interest rates low, but some bonds will have attractive returns. Easy and hard to follow at the same time and find, excuse me. Equity managers recommend at least a 25 to 30% bonds as of January 21. Mega companies like Google, Amazon, Microsoft threaten again to take over everything. So this sector in the last decade did 3.54%, which is decent, but is it not significant enough to do in your retirement portfolio? Again, the Biden administration is going to be much tougher for small caps. So this could be recommended for general portfolio. So this is one of those scenarios during this whole, if the lost decade reappears itself, this is something to look good for. And our personal recommendation, Michael's and some of the other brokers we've talked to that's helped with this presentation, that this is something to look into in diversifying your portfolio, is this sector of the portfolio. How about international development? I mean, portfolio grew at 17.47%, compounded 1.62%. But international stock indexes have shown some terrible performances. However, international stocks did outperform US-based S&P 17.4 to -9 over that the lost decade, and yearly from 1.62 to 1%. 1.62 does not sound attractive, but if you could push the clock backwards from the last decade, and they're going to say, hey, you're going to make 1.62% for the next 10 years versus you're going to lose 1% for the next 10 years with fees, which one would you go to? But however, European countries are most likely socialist where government claim fruits of capital investments and redistribution. Excuse me. Most equity managers are recommending international stocks since President Biden is partial with China, etc. ... We don't know where that's all going, so yes, where the ... is. Again, from all of us, this is not recommended for long term. These did outperform the S&P, however, during the last decade. So that's something to consider if the last decade comes over again. How about the emerging markets? Portfolio out there grew by 154% during the last decade. Compound yearly growth was 9.8%. But again, strong over performance, but look at the huge savings, the huge swings, over 110% swings during this time frame with these emerging markets. A lot of people can't stomach those swings. It's just like, oh, it's like missing a 2-foot putt on the first hole. You can't stomach it and you remember it for the rest of your round and you're hoping to try to get over that. Emerging markets can go fast, but see the Obama darling Solenda Energy. See how that went so well. No one puts all their eggs in the totally aggressive portfolio in bearish times. For all of us, this is not recommended for risk reasons. Also, not as many emerging tech companies in 2000 when Google, Amazon were just entering the growth phase. Now we're going to jump into real estate real quickly. I mean, wow, real estate people have been making a killing over the years. The last 10 years alone, I mean, houses, boom, 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 boom. But how did it do during the last decade? Well, portfolio grew by 135 plus change and compounded of over almost 9% interest. Wonderful. I mean, strong overall performance driven by a seller's market with scarce inventory and very low interest rates. That's something to consider. Mortgages are no longer a tax advantage now with the new laws going into effect. Mortgage rates, historically, they can't remain low. I mean, you're starting to see them creep up a little bit. I know some clients try to refinance their house. You know, they were getting at 1.75%. Now it's creeped up to 2.75%. It's slowly growing up. And fund managers are recommending vacating REITs or greatly reducing them as of 2021. Why? Ask one. They'll tell you the real reason. Again, from all of us, not recommended. Mortgage party could suddenly end at any moment. And we all saw what happened in 2008, 2009, and how long that lasted and how long the recovery took from the mortgage industry. Could this happen again? Now, let's, whoops. Look at the last decade here in this aspect, and just strictly cash. I mean, the portfolio in a cash account grew at 34%, compounded of 2.98%, but not efficient enough for retirement strategy. Cash interest at banks in 2021 right now, if you're lucky, on some of them, unless you like credit unions are a little bit better, I recommend those highly. 0.01%. Doesn't keep up with inflation, doesn't keep up with fees, anything. Cash is literally stuffing a mattress and losing it to inflation. Portfolio managers are recommending a 5% cash position at most, with bonds being the safer bet. That's true. In our opinion, it's sitting your money in cash, we like to call lazy money. We have a great piece on our website on lazy money and how it affects over time frame with the loss of inflation. And just got a question, and thanks, John. Yes, we can get you a copy of the Lost Deck lazy money article. Not a problem. We'll send that over to you after the presentation. Yeah, you've heard about lazy money. Yep. Well, lazy money is money that's just sitting there. It's lazy. It's doing it. It's losing money to the cost of inflation. It's losing money to everything. But it's people have this mind frame of, Dolph, it's liquid. I have it there. That's wonderful. But you're not making anything on it. Well, that's okay. But I might need this money. And I'm going to ask you. I'm just going to use John as an example. Sorry, John. I know you're on. There's a John, actually 2 Johns on the presentation today. But John, you have $200,000. You're 65 years old, sitting in a money market account earning 0.01% because you want to keep it liquid in case of needing it. In your 65 years, what's the biggest check you've ever written in your life at one time? And besides a house, you might say a car. I wrote a check for $30,000 for a car. God forbid a medical bill or something like that. But generally, the biggest check someone's written in their lifetime is around $10,000 to $15,000. I'm doing the average of all the clients I've worked with. So why would you think at any given time, what are you going to use $200,000 for at one time? Why not put it in something earning 2, 3, 4, 5% and getting some guaranteed return on that money, still having liquidity to that money? Because you're not going to need that. I mean, even at a 3.5% clip, that's $7,000 a year. And every year, imagine in January, someone comes up to you and say, "Here, John, here's $7,000. Are you going to turn it down? Are you going to say no? Or would you want to say, "Hey, John, here's 25 cents. Which one do you want?" Of course, you want the $7,000. But there is $7,000 that you're earning money on. That's what I'm talking about with the cash aspect of this whole thing, of don't get trapped into the lazy money game with uh, money managers and so forth, like going forward. So we visited all these different areas. So let's just do a mixed performance of all these stinkers. We got the U.S. bond at 10%, small cap at 15, high yield at 4, S&P at 35, international develop at 20, emerging and real estate at 5%, international bond at 4, and we're going to put 2% in cash. How did we do during the last decade? Having this whole diversified portfolio. Well, the total portfolio grew at 28% during the last decade, which is a 3.22 yearly rate of return. Okay, a lot better than it is because you're diversified. At least you went up a little bit of money from beginning to end. You went up from $1 million to 1.37 million. Heck, a lot better than being down to $200,000. But do you understand how all these can work? I mean, recommended up and downs. Are you willing to take a risk during a lost decade happening again, that this is what your portfolio might do? And if, and God forbid, if this ever happens again, and you had $1 million now and you didn't mix these things properly up there, and your portfolio dropped while taking money out, and you're only at 30% of your money left after 10 years, is that a situation you can be in? That's just a question you have to ask yourself. Again, everybody's situation is different. We're just trying to show you the what ifs this could happen in the diversification process. And as we're going to show you is, again, that same mixed portfolio taking out 5% withdrawals. And you can look at the numbers, 2.62% versus 2.45% on the compounding performance of the withdrawals and the actual portion of the withdrawals. Actual numbers are happening. So you've taken this money out, you've taken out $400,000 over the 10-year time frame. Your portfolio's dropped, or it's still $800,000, but you've lost all this spending power of what ifs. I mean, the compounding of withdrawals, which I'm going to show you in another slide here in a second, of the best way to make money is not to lose money, is going forward. And that's where having a mixed portfolio is wonderful. I'd say over 95% of my clients have another advisor that they work on the risk side. We work on the protection side of Clear Income Strategies Group. We work on the guarantees, the knowing versus guessing. And what we're trying to show you is this side of the portfolio you're looking at through the last decade, if it happens again, and you're not diversified properly with guarantees and stuff, could totally affect your portfolio going forward. And the bottom line, a decade of intense portfolio management delivers a 2.45 compounded yearly performance, but you have to take out, this doesn't take out broker fees, inflation, trade costs. Boom, at the end of the day, the decade is lost because you've lost all that money, because that 2.45% return, imagine if you're paying 1.5% in fees or whatever it might be for trades and broker fees. Now you're starting to get the negative numbers. I can't show the negative numbers for compliance purposes because I can't add in fees to here, but you can actually put in your mind the fees that you're paying, 0.75 to 1.5%, deduct them compoundingly, and guess what? You're in negative numbers for the last decade. Now, I know a lot of people out there is like annuities. Oh, get off. You work with annuities. Yeah, I've been with them for 17 years. I love them and I hate them at the same time. The part I love them because they offer the guarantees, they offer the protection, they offer protection against the unknown. The reason I don't like them and I hate them is it's the wrong annuities are offered to the wrong people a lot of the times, and that is just very frustrating. Is they're put into something that's not right to them. But here's a side-by-side comparison of the S&P 500, and I even for kicks and balances, I added 2010 into this last decade just to show you the difference of apples and oranges, because I'm giving an extra good year of returns in there. Now imagine that on the left side, you can see on your screen, you got $250,000, you're taking out 5% of your portfolio. And on the right, and then next to the par rate, let's just say, and then you put yourself in an annuity, you get 50% of the S&P gains and none of the losses. Look at the bottom. Look at the bottom of your screen down here, where at the end of that 10 years of the lost decade, you're down to $75,000 in your portfolio. Where in an annuity, since they're so bad, well, heck, look at this, you're at 205,000. I mean, you have not lost anything. You've lost 50,000 compared to $150,000. You got $25,000, $130,000 more just by eliminating the zeros, just by keeping the zeros in there. That's very strong. It's like you stay on that path in the lost decade. And mind you, if I showed you that, look at 2009, look at the difference there. I mean, it's huge. On the right side, let's just say, and mind you, no fees attached on these whatsoever. The annuities don't have any fees. If you had fees on the S&P 500, you might be a heck of a lot lower than that. On the right side, we're just going to do simple 250 during the lost decade. Didn't touch the money. On the right side, you get 50% of the gains. Look at what happened over the 10-year time frame. Annuities went up to $370,000. Your S&P portfolio is at $200,000. That is a huge one. That's what I really want to show you on this about are annuities really that bad? It's for the protection aspect. At the end of 10 years, we had another lost decade. Would you rather have 370 or would you rather have 200? Changes your whole portfolio. At the end of the day, annuities are safe and certain in a chaotic environment. Options for income, legacy, immediate, and deferral are a lot of the options for annuities. And this is all about what happens if the lost decade returns itself. Again, I thank you for all the questions. I thank you for taking your time to join me today. I have a Calendly link called calendly.com/DolphJanis. We have times blocked off for you guys. If you'd like to schedule a time to meet in person, a Zoom call, a telephone call, or just to get some general information, please go ahead and click the link and schedule that. You know I'm an educator first, a presenter, an advisor second, excuse me. You can go to godriousavings.com. I put all my resources out there. I don't hide anything because I want to make sure you're educated first and know what's going on second going forward. So please visit that there. Here's a disclosure once again that I am not a tax advisor. I'm not an investment affiliated with FINRA or the SEC or the Social Security Administration. These are all advices and actual fact numbers that we've put together. So again, thank you for taking the time to join us today. If you want to see the next series of webinars we have going on, you can go to donotlosemoney.com and it'll always show you the list of all the presentations of education we are presenting them. I invite you to follow us on Facebook or LinkedIn and go to clearincomeforlife.com. Again, God bless everybody for taking the time to enjoy this presentation. I know it was a lot of numbers and I hope to talk to you sometime in the near future. Take care and stay safe.